Okay, so it's my pleasure to introduce Dr. Fan Yang from University of Waterloo. Her primary research interest lies in the areas of quantitative risk management, actuarial science, and mathematical finance. So she has been working on a few topics, including extreme value theory in insurance and finance, asymptotic analysis of real events in insurance and finance, risk aggregation and risk measures, and heavy tail distribution in the presence of dependence. Today, she's going to tell us about her recent research on diversification in insurance markets. Let's welcome Dr. Yang, please.
Thank you very much for the introduction, and also I'm very thankful to Tian Dong to invite me to give a talk in this very famous department, so I'm really honored. Okay, so as you know, my research area is not really in statistics. So today I'm gonna talk about a few applied questions in quantitative risk management or in insurance. So hopefully you can find something interesting to you. Okay, now let's get started. So my talk is mainly on the diversification. So first, let's see what exactly diversification is. Okay, so to put in a simple everyday language, diversification can be understood as don't put all your eggs in one basket, because when you drop the basket, you may break all the eggs, right? But in more formally, that means diversification is to reduce the exposure to any type of risk. And in a portfolio setting, that means diversification can be reached by investing in a variety of assets. And to see that why diversification can be reached by investing in different assets, we can see through the classical, if we go from the classical mean variance portfolio optimization setting. Here, the XI's are the return of the asset, and the variance of the return is taken as a risk measure for investing on this asset. And then because of this relationship, so the standard deviation of the portfolio, because the WI here are the weights you invest on the one particular asset, and then the summation here, that means it's a total that's a risk for when you invest in this portfolio. That's the left-hand side. On the right-hand side, we understand this when you invest the money on a particular one asset. So this inequality tells us that the risk when you invest in a portfolio is always less than or equal to the when you invest in the individual asset. And only when all the assets are perfect correlated, the equality holds true. So that's why in the classical setting, people always think, okay, when you invest in a portfolio, it always can reduce your risk, and so that's why it's a good thing to do, rather than just invest in a single asset. Okay, but that's in the classical setting. Now, after the recent financial crisis, I mean the 2008 financial crisis, and also the recent climate change, extreme risks are become the more concern for the people. So extreme risk means the disastrous outcomes, but they of course have a low probability. And for such risks, the variance apparently is not a proper measure for that to measure the tail risk, because people now really care about what happens in the far end, in the tail, where the extreme occurs. And then instead, the value-added risk, or short for VAR, is widely applied in industry to measure the tail risk. So VAR, in short, is just a generic quantile of a function, of a distribution function, so at level Q. And the VAR tells us how big the loss is at the level of Q. And also the regulators for the insurance or for the banking system, they also kind of recommend to use VAR or even other tail quantile-based risk measure as a risk measure to determine the capital reserve. And they also usually require, if you use VAR, they require to use at a high confidence level of VAR. That means the Q here usually required to be at least 95% or even 99% to evaluate the risk. So now, let's see, if we replace the risk measure from the standard deviation here in this inequality by the value of the risk, actually this inequality is no longer holds true all the time. That means the direction can change. In other words, the diversification can be sometimes suboptimal. It's no longer optimal all the time. So in that cases, that means if we use VAR as a risk measure, then some portfolio may be even, it's not a good idea to invest in those portfolio. It's even better just invest in the asset itself. So now you can see in the common sense, diversification can be reached by investing in the variety of assets. That's purely is more based on the understanding by using the variance as a risk measure. But if we change the risk measure, the story can totally different. Okay, so today I'm gonna more focus on if we use VAR, what happens to the diversification. So if we agree, we're gonna we're gonna use VAR as to measure the risk. Then now the diversification benefit can be measured through this ratio. So this ratio is in the numerator we have the VAR of the portfolio. So this gives us the risk to invest in this portfolio, and divide by the risk of investing in the individual asset. So compared to the previous this inequality, basically we just have the ratio from the left hand side divided by the right hand side. Okay, so and then we kind of quantify to really quantify what exactly how much diversification is being reached at any certain at a certain weight. So here again, the W means the weights. So we only take the positive weights. So that means we do not allow the short selling. So here, in this DR, in this form, itself is not directly the diversification benefit, but the 1 minus this DR measures diversification benefit. That means the DR, if DR less than or equal to 1, that means the risk of the portfolio is less than the risk of investing in the individual asset. Then we say diversification is optimal. That means it's optimal to invest in the portfolio. Otherwise, if DR is greater than 1, then that means the risk of investing in the portfolio bigger than investing individually. Then we say diversification is suboptimal. Okay. So here, by using this DR to really quantify the diversification, we can do a few things. Today we're gonna focus on the 2 levels of understanding diversification. At the company level or at the micro level, that means we can use a DR to do a optimal portfolio construction. So we can find the most diversified portfolio is to find the optimal weight such that it can minimize this DR ratio. Okay, this DR. So this is by considering this DR as an optimal strategy. But at the macro level, if we look at the market level, and then we can consider, of course, in a more rough setting, well, we're gonna we just consider the weights as equal weights, because here you can imagine we are looking at the insurance market. So the equal weight, that means here, if you look at this VAR in the numerator here, that means the insurer, you can understand this as an insurer to share all the end risk, catastrophe risks with all other insurers equally. So this weight means how the different insurers share the risk. So it's different understanding than in the portfolio optimization. We understand the risk as how much money you invest, how much portion of the money you invest in a certain asset. But here the weight is more like how they share the risk among the different insurers. So the numerator means if the insurer willing to participate in the market, we just simply assume that they are gonna share the risk equally. And in the denominator, compared to the other position, if they do not participate in the market, that means they're gonna take the risk all by themselves. So then that's the value of the risk of the X1. So they just take X1 all by itself. Okay, so then this again can be understood as a way of diversification. Compare the two positions of the insurer can take, whether participate in the market or invest on their own. Okay, so based on this understanding, then we're gonna investigate when the diversification is suboptimal or optimal. That is basically whether this DR is less than or greater than what. In what conditions these two inequalities can occur, and more importantly, how the diversification can transit from suboptimal to optimal. Okay. So that'll be the goal for this part. Okay. So next, I'm gonna first talk about at the market level how the diversification is useful to solve some questions in the insurance market. Okay, so let's see why this diversification is relevant. First, there is a protection gap in the market. Let's see what is that. So Swiss Re, this company is the second largest reinsurance company in the world. And in this company, they also do a lot of research on the catastrophe insurance market. So they provide a lot of data and research, also their own research. We can see what really happens in the real market, insurance market. Okay. So according to their report, they said that the total losses from natural catastrophes across the board for the year 2017 and 2018, this total losses is nearly $500 billion US. Okay, but on the other hand, the total insured loss, that means the losses, that part is covered by the insurance. Okay, if from the natural catastrophes, in the same two year period is only 219 billion US dollars. So that means the losses covered by the insurance is even not half of the total actual losses from these catastrophes. And even this insured losses, this amount is the highest ever over the 2-year period before 2018. So this shows that there is a huge protection gap in the catastrophe insurance market. That means there is a huge financial losses generated from the catastrophes, but not covered by the insurance. And such situation actually is not new. It's not just recent in the market. It has been existing in the insurance market for decades. Okay, so next, this graph shows you the better idea how it happens around the whole world, the protection gap. Okay, so in all of these sub figures, the orange curve shows the total losses, but it's a 10-year average. So each point on this curve, that means the 10-year average of the total losses. And for the blue curve, that is insured losses. Again, that's 10-year average. And then the difference is marked by the gray bar. So that's uninsured losses. So you can see around the world, Asia actually has the most significant protection gap. So it has a total losses up to $77 billion, but the insured loss is only 11. So $66 billion still uninsured. So that part of losses are uncovered. North America is better. The total loss is comparable to the Asia, but still almost like half of the losses are not covered. Okay, so this is a graph from the average from 2009 to 2018 average. So you can see it's existing in the market for a long time. The trend is getting larger, actually, uninsured losses. Okay. So now this such protection gap shows the failure of the catastrophe insurance markets. And why is that the failure? The insurance market doesn't really work for the catastrophes. There are a lot of research actually devoted to this area. Two major reasons we can see from the literature is, the first one is the market itself is imperfect. That means the market actually has ability to solve the issue, but it just doesn't function as it should be. Okay, actually, this indicates the coordination problem or how the market should be a management problem. And the second explanation is due to the heavy tailness of the losses, because a lot of empirical studies have support that the catastrophe losses they're heavy-tailed. That means they have a potential produce huge losses, but with relative not so low probability. That means heavy tailness. And because of heavy tailness, and that makes the company such huge losses maybe out of the control, or maybe out of the range of, or the ability for the company to cover. So that's two popular explanations. One is from the market side, one is from the modeling or the understanding of the losses this side. And the other explanations, such as lack of information, because we can always say we measure we can estimate all the losses very well, right? Because it's still after all, it's a catastrophe. So you cannot gather all the informations. And also there are some problem in estimating the underlying loss distributions. So all of such problem will prevent the insurer to have a good to underwrite a good insurance contract. So especially if there are loss risk aversion, this will also prevent them from participating in the market. But still keep this two problems in mind: the market problem and also the heavy tailness in mind. And if we look at from the today we're gonna look at these two problems through the diversification point of view, to see how these two questions can actually be answered, or whether there's a solution for that. Okay. First, actually, there's a phenomenon called the non-diversification trap. That means in the market, there's you can never, the insurer, the player, the participants cannot really find optimal position. That means they cannot really diversify their risk. So that's why they do not want to participate in the market. Then that's called the non-diversification trap. But let's see, in the market, the Swiss Re again estimated that the total capital, right, in the non-life reinsurance markets at the end of 2018 was more than $2 trillion US. So this is a really huge amount for the total capital the non-insurance company are holding, non-life insurance holding. And I recall that the average of the total losses worldwide, is from the 2009 to 2018 were only were about $194 billion. So compare these two numbers, we can see the total, the market, the catastrophe insurance industry actually is well capitalized to underwrite the catastrophe risks. So that means they have the ability to really to write the insurance contract to cover the losses. But then what happens? They stop offering such catastrophe insurance contracts. Actually, one reason is the regulations is the major reason that they often force the insurance company only operate in their local state. So that means they often force their geographic or the insurance lines specialization. So that means they only charter in their own state, not like a cross state. Such share risk is not really allowed by the regulation. And in that case, for the companies in each local state, especially in the United States, the situation is very obvious. That is the case. Insurance company will usually have a high cost to really cover the catastrophe risk in their own state. So that's why diversification is hardly reached in the industry level. It's only always has to be undertaken by the local company. So that's why a lot of private companies do not really want to participate in the catastrophe insurance market. A good example is a California earthquake. So the majority of the California earthquake is covered by the California Earthquake Authority, which is operated by the state of California. And very few portion is covered by the private. So this shows that there's a very huge issue about the inefficiency in the risk sharing in the market, and also it's necessary to really have the government coordination to come in. So, but actually, in our study, in the simplified model, we can show that the optimal diversification is still attainable. Here is a quick preview of the result. So on this graph, we plot that the DR, the diversification ratio on the y-axis, and on the x-axis is the number of insurers. That means how many insurers are sharing the risk. So you can see, starting from the 2 insurer and increase to 3 insurers, the DR is increasing. Recall that when DR is bigger, that means diversification is worse. So when DR is less than 1, it's optimal. When DR is bigger than 1, it's suboptimal. So that means when we insure the number of insurer at the very beginning, it seems like the diversification is becoming worse. So that certainly prevent insurer to really join the participate in the market. But if they continue to more insurer comes into the market, you can see this DR is decreasing, especially after if more than 5 insurers are participating in this market, then eventually DR is decreased to below 1. Then that's where diversification become optimal. In other words, that means to each insurer, if they participate in the market in this area, then they can reduce their risk by sharing the risk with others. Rather than just taking the risk all by the insurance company itself. So this shows us that by increasing the number of insurers, it's possible to obtain the optimal diversification. And then that indicates the necessity of the government coordination. That's the government the role to persuade more insurers to come into the market, because then eventually everybody can get the risk diversified. Okay. And here I have to point out our model is not complete new. It is based on the combination of these 2 previous, mainly based on these 2 previous papers. Okay, now let's go into the more detail of our model. The first is on the marginal risks. So we consider the heavy tailed distributions. This is backed by the support by the empirical studies. These such studies have shown that the economic losses from the natural disaster can be justified to have a power law decay tail. So power law decay, that means the tail is behave like a power function. More formally, we can characterize this property by using the regular variation. So the formal definition is given down here. And f as a distribution function and f bar is a survival. So we denote the f bar is regular varying if it's satisfy this relationship. So it's so roughly it is if f bar is a power function, you can see directly without taking the limit, the equality holds true. So roughly you can see regular varying is about the power tail. It is a more general way to describe the power law. And here, the index is very important in the regular varying. So this index represents a heavy tailness of the x. Smaller alpha means a heavier tail. Heavier tail means a higher likelihood of the enormous losses. So larger losses getting is more possible. And another thing is on the range of the parameter. Because for the catastrophes, we understand catastrophe have disastrous consequences. That means we want it's more reasonable to model them using more heavy-tailed distributions. Actually, some empirical studies have shown like some earthquake losses, they do have a alpha tail index less than 1. So here we also restrict alpha less than 1. And this condition here, not just a practically catastrophe have large losses. Also, you will see this appear as a technical requirement. It's necessary to have such. So you will see in a few minutes. Besides the heavy tailness on the risk, also usually for the catastrophe risks. Typically, people just simply assume that's a real valued risks, but in a catastrophe risk setting, the negative value actually lack of economic interpretation, right? Because they're really a profit from such catastrophe event. So here we just focus on the non-negative. Assume they're non-negative. Actually, by restricting the x to be non-negative, it's possible to get a final result. We also compare the result to the real valued in the real valued setting. For the real valued setting, you will see the result is not as sharp as for the non-negative. So non-negative here. On one hand, it's more practical requirement. On the other hand, it also allows more final result available. Okay. And the next is another kind of important part in our modeling is a limited liability. So this is a practical requirement, but it may seem like a contradict to the power law decay phenomenon. So since now we're here talk about the power law decay, but then we again pose a limit up there. Seems like we're actually truncate, then make the tail is no longer that heavy. But actually, this is a very practical reason for that. The reason is that because the probability for huge losses from the catastrophe is so huge, it's non-negligible because of due to heavy tailness. This to avoid the insolvent for an insurance company. So they usually put a cap in their the insured loss in their catastrophe in their contract. That means the insurer won't cover all the losses, any losses from the event. They will have a limit there. They cannot cover anything. Okay? Otherwise, they certainly will make their bankrupt. So because of this, from the practical reason, there's always a limited liability for the insured. And here we denote by use K to denote this limit liability, and the actual insured loss for this X is when the X is below K, then cover whatever the X is. If X exceed the threshold K, then the insured contract will only cover the K loss here. So this limited liability here, this is actually the key assumption or the component in this part of the work. Without the limited liability, actually it's never impossible to get the diversification optimal. Diversification is going to be always suboptimal. So actually, just because of this practical requirement, practical needs to impose limited liability, that make the diversification optimal possible in the market. Okay, we'll see. And next is on the dependence. So now when we have a different risks facing the market, in the past, always they just assume this IID assumption, but certainly the dependence is more reasonable assumption, because whenever the one catastrophe occurs, especially those weather-related disasters like a flood, a drought, or earthquake, it will affect multiple areas and not just for the single one company. So it's really reasonable to assume a dependence among the risks. And here in this work, we assume Archimedean copulus to capture the dependence. And such group, this class of copulus are known to capture the for the tail dependence, especially for the extreme losses. It covers a wide range of dependence from independence to common tonicity. So independence is just everybody is independent, and common tonic, that's the strongest dependence. So all the risk move in the same direction. It means common tonicity. Typical examples like Clayton, Gumbo, and Frank. And the formal definition of Archimedean copulus is given down here, and it is defined through the generated function phi. So phi is from 0, 1 to 0 to the 0 infinity. It's continuous, decreasing, and convex, and satisfies such condition. And the phi inverse, phi -1, this is denoted by the inverse of the phi. Okay. So this is the Archimedean copula. And in our setting, since we focus on the tail dependence, where we care about where the extreme losses are dependent. So when we impose a dependence, we assume on the survivals. We impose on the survival probability. So we assume the survival follows the survival probability follows Archimedean copula. So C hat here is a Archimedean survival copula. Itself still is just well, it's just a notion, but itself actually is still Archimedean copula. Okay, follow the same definition here. Now, to better control the degree of dependence, we assume the phi, the generative function, is regular varying at 0. So the reason at 0 is, you see here, the 0 is where the f bar x, when x goes to infinity, when x is very large, that's where the big losses occur. So f bar of x is going to 0. So that's why this assumption is at 0. The regular variance is at 0. Now here is the regular, it's RV with tail index beta, and the larger beta, that means stronger dependence, and when beta close to 0, that tends to independence. Okay, so that's how we control the dependence. Now here is how we really measure the diversification. So that's the setting of the market. So here the XI is ith insurance right standard loss random variable. So that means that's for the insurer I, it has a liability of K, and it will just, when it covers the catastrophe loss, catastrophe risk XI, it only covers up to K. So XIK is extra insured losses for the insurer I. And for each insurer, 2 positions is for them to have in the market. The first position is if they choose to participate in the market, that means here we assume they're going to share all the catastrophe risk in the market equally with all other insurers. So that's how they participate in the market. So since they share equally, then all the risks X1 to Xn that's a risk in the market, so they share equally. And Snk is the risk the insurer I is taking. If the insurer chooses not to participate in the market, then that means it will take its own catastrophe risk, say entirely. That's a risk Xik. Okay. Now compare the diversification. Then when we look at the diversification, that means we'll compare the risk of these two positions. The one is when they can participate in the market, that's Sn, and compared to the risk, they do not participate in the market, that's X1 is off. So that's the DR, the diversity ratio we consider here. And we are gonna study when is the asymptotic suboptimal or optimal. Okay. So before I present the main result, here's a closer related question to study this ratio here. The var of Sn and over var of X1 is a subadditivity of var. Okay. So that is the var of the summation of xi is less than or equal to the sum of var. If this direction of inequality holds true, then we say var is subadditive. And it's well known in the literature that the var is not always subadditive for all kinds of the risk xi's. And it has been studied under various models, including dependence, light tail, heavy tails, in all of the settings. If we just focus on the heavy tail, the situation, and a very general result covers all the known result is under the multivariate regular variation. So that means if X1 to Xn are multivariate regular variation, MRV is a generalization from the one dimension to the multi-dimension. If I have time, I can give you the formal definition, but here just understand MRV is a multi-dimension version of the regular variation. And with tail index alpha, and it has been shown that var is subadditive if alpha greater than 1. So alpha here, again, controls how heavy each X the tail is. Okay, alpha greater than 1. That means it's the tail, all the marginals, they have finite expectation, finite mean. And to interpret this result in our setting is without the limited liability. So that means in the literature, of course, people just study the risk itself. They won't consider impose a truncation there, right? The limit there. So under this, without a limited liability, and when the marginals have a finite means, that means alpha greater than 1, then diversification is always optimal. So under the MRV setting for the heavy tail, so when the tail is not that heavy, alpha greater than a finite mean, then it's always subadditive. So in our language, that means diversification is always optimal. On the other hand, if the marginals are really is extremely heavy, that means with infinite means, then the diversification is always suboptimal. So now you can see without imposing the limited liability, if we consider extremely heavy tailed distributions, then diversification in such market is always suboptimal. That means there's no way for any insurer to participate in the market. However, due to the practical requirement, the limited liability clause in the catastrophe insurance markets, even for the alpha less than or equal to 1, for the infinite means the situation, the diversification can still become optimal. This is mathematically very intuitive, because when you impose this limit up there, you make the tail is no longer that extremely heavy, right? So that makes the diversification still possible. Okay, Now here is our result, the main result here. So when the X,
Can I ask a question about the limited liability?
yes.
So if you have, say, 5 insurers in the market, do they each have the same limited liability? Is the limited liability 5 times what it would be for a single insurer, or is the limited liability assumed to be the same as the total for all the insurers?
Okay, so for a liability, that's the same here in our model. We just assume that that's the same for each one. And when they share the risk, the liability does not change, because eventually when they share the risk, they only take, say, 1/5 of the risk, right? So when they add it together, it's still like a one risk. So it won't increase the liability level.
The total liability level.
Right. Well, the total one. So the total still keep there.
All right, thank you.
Yeah.
But you are assuming, Fan, you are assuming that they all have the same limited liability, right?
Yes. Yes. Here in this structure, we assume it's they all have see here the first result here. So we assume they're identical. So yes, the K is same for everyone.
Would that, I guess that would be more complicated to analyze if you allow them to have different ones.
Yes. Yes.
Yeah, okay. In your theorem, it was my next question I see as obviously K has to be related to Q, because you know, if you take Q large enough, then a small limited liability is basically going to wipe everything out, right?
Right. Yeah. Exactly. Actually, I'm gonna discuss why this assumption in the next slide. So how this works.
Thank you.
Yeah. Thank you. Okay.
I also, so I'm not sure whether you have already tried relaxing those assumptions on the same limited liability and same proportion of risk sharing, but because even if you relax that assumption, because I think intuitively the whole point is to limit so that the insured loss is not hereditary anymore. So my intuition, I mean, from your presentation is that even if you impose different limited liability for each insurers, I guess that the same kind of diversification benefits can be attained, I guess?
Yes, it's possible. Then actually the only complication here is how we control how the liability relate to the VAR, well, to certain this quantity here. So if relax, we can relax in the of course in different ways. If we say just in proportionally different, this one is really is with C1, the next one is C2. So but essentially C also is gives you the idea how the diversification is transition here. So this level of C when this coefficient is larger, then that makes the diversification is no longer suboptimal, no longer optimal. Yeah, so it's very essential K compared to the VAR here. This coefficient actually kind of control how the diversification is transited. If it's relaxed to a different in a different setting, it may I feel like it will make the result more complicated, and it's not the very straightforward current for right now. I see it because this because of the K, they're all identical. Then the C, we can show that how the C, like a large or small, how that affect to everyone. But if this K all different, then probably this will make the story more complicated, I guess. So, yeah, I haven't really thought that into too much.
Yeah, right. I mean, yeah, but I think, but the whole point is that the heavy tail is limited by the limited liability. So I think the similar thing could happen. That's just my brutal guess. And another reason why I'm talking about this is because in reality, different insurers have different amount of their own capital.
Yes.
So it is unrealistic that every insurers will share the same amount of the risk, because depending on their different level of their own capital. So I think it's interesting to make some variations to the insured amount and see what happens. I was just wondering what happens. But my guess was that similar thing could happen, but just my guess.
Yeah, sure. Certainly, that's a very good point. Yes, certainly. If you just say roughly, not just get exactly the same session, because here we get a very exact transition here. But if you just want to get a more general, say, result, like say when this coefficient is large, that eventually it becomes suboptimal. So that I believe that still holds true. That's no problem. It just probably is harder to get a final result like this. And yes, again, also the K should be different for different insurance. That's certainly more realistic assumption. Yes, I agree. Okay, so here I guess you already have seen this main result. So basically, besides the modeling we just earlier mentioned, so follow the Archimedean copula, and the phi is regular bearing. Also, there's a key assumption that we assume the liability grows with the bar at the rate of C. And this coefficient C actually plays a role to characterize the diversification. So if C is bigger than N, N is a number of the risk, the diversification is suboptimal. But if C is less than N, then the diversification is optimal. Okay, so now let me first explain why this assumption here. Okay, so first of all, formally this notation, the theta means it's equivalent, asymptotic equivalence. So that means the ratio on the two sides is 1. The limit is 1. So or K over var is equal to C. As Q goes up to 1. And since the X are the extreme losses unbounded, so that means implies that the K diverges to infinity. So how do we interpret this such assumption? First of all, by the regulatory requirement, the VAR actually can be understood as a capital requirement for the insurer to underwrite the X. So that means if the insurer wants to insure the X, then they have to prepare accordingly this amount of the capital to underwrite this X. So intuitively, higher liability requires high capital reserve. That means if they want to raise the bar on the contract, the limit, the capital, the liability, then also that requires a higher capital reserve. So that's why it's intuitively or practically reasonable to require the liability grows with the bar. That's a capital. And technically, if this K is fixed or does not diverge to infinity, then actually this only leads to a trivial result that the DR is always 1, because in the DR the ratio, both the numerator and denominator eventually is K when Q goes to 1. So then that's a trivial case. So this is both practically needed and also technically needed assumption. And if we look at the to what we get from our result, first of all, that shows the switch from the suboptimal to the optimal when the liability changes. So that means when the liability compared to the capital reserve, see how big, if the liability is really large, then that can make the diversification suboptimal. And second, the transition really does not depend on the alpha or beta. So alpha is a heavy tailness, beta is a dependence. So that means if we're in each state of diversification, suboptimal or optimal, no matter you make the marginals less heavy-tailed or less dependent, it won't change the diversification state. So as long as the liability is large enough or small enough. And so mathematically, this can be understood as because K really is kind of cut off the really heavy tail part. So if K is large, then that means the risk is still really heavy. But if K is kind of relatively small, then that means that makes the tail is relatively lighter. And on the other hand, if we fix if we keep the liability and the capital reserve like fixed there, but we look at if we change increase the number of insured, that is if we keep the C here, all of these things fixed, but if we change the N, so that means we can, if we increase the N, then eventually we can make the N greater than C, then that means eventually we can achieve asymptotic normality. Diversification optimal, then that's actually the figure I showed you earlier. By increasing the number of the insured, eventually we can achieve the the diversification optimal. And so this actually shows the coordination is the key in such market. So by allowing more insured in the market, eventually it will benefit everyone. Especially in the market, they certainly have the capital, the total capital to really cover the losses. So that means they have the ability, but they don't really know that they all have to participate. More people need to participate in the market. If only just a few of them, they may still see suboptimal, but just one more involved. So this will certainly motivate they share the risk in the market. Because of time, I guess I will just quickly go over a few things. So for the real, just now the result is under non-negative result, but for the real value of the risk, the similar things holds true, but the transition is no longer as sharp as a non-negative situation. So you can see there's a gap here, and this quantity, we can show that this quantity is greater than 1. So in the middle, it's really from the current research, we don't really know what happens. And this is because the real value, the random variables, so the negative part compensate the positive, the huge losses. So that makes a diversification. This will actually result in more diversification benefit. And here I also want to show you why the non-activity on the marginals actually allow us to have a finer result. Actually, that is because on the non-activity we can have a better rewrite those probabilities to have a better, more accurate bound on that. Okay, and then finally a few plots shows you that really that verifies our result. Okay, by increasing the number of the portfolio, the number of insured, that will certainly change the diversification, and also by changing the dependence or the heavy tailness, it won't alter the diversification stage. If it's suboptimal, always suboptimal. Okay, and also for the real value of the case, different number of insured will be occur in the market. Okay, so then that's all for the first part, and that's all. Thank you.
All right. Thank you so much for the excellent talk. So it's time for questions. Do we have any questions, speaker?
I guess I have one.
Oh, go ahead.
Okay. So in your current model, you probably have to restrict yourself to one particular choice of your copulars. So I'm wondering if it's possible to generalize the framework a little bit so that you can model everything in terms of multivariate regular varying plus hidden regular variation, so that you can model the tail dependence directly through angular measures or whatever other things.
Yes, it's certainly possible if you through our the proof that I didn't show you. So all the previous steps are the same. So basically, trying to rewrite all the summation, try to eventually into the individual into this form. So that means go from the summation to the individual ones. And then from there, you can see if we can eventually go to the step, then all the dependence and the marginals, thus assumption where that kicks in. So where, how such probably converge. So how such probably converge. So when you change the dependence model, then that's just different result. So the dependence itself doesn't really restrict the current proof much. So only the limit will be different. So okay. It's really possible to generalize to other structures.
I see. Okay, thanks.
Yeah.
Well, I have a question. It was a very nice talk, easy to follow. One question I have is on the limited liability K. Does the reinsurance company decide what the value is, or other companies have input in it?
Usually the company itself, they decide their own the limited the liability, because based on their own understanding of their insurability, based on their own understanding of the risk and also their own capital reserve, so they will set at a reasonable level of the liability level. So yeah, I would say different companies, they have a different ones. But the comparable companies, in size-wise, they probably have a very similar liability level.
On the issue of optimality, is it a mathematical optimality or from the perspective of the companies or the reinsurance company?
Yeah, so for the reinsurer generally they cover, they take care of the catastrophe, catastrophe markets, because for the general insurers, they will cover like in the middle range of the risk, like usually the regular car, for example, the car insurance, that's like in the middle range. But for those extremely large, for the catastrophes, usually that the last layer of the loss go to the reinsurers. So for the reinsurers, so they still cover just a one layer of the loss. That means there's a cap in their contract. So the optimality certainly, because they're for the insurance company or reinsurance company themselves, they have to, on one side they have the liability to write all the to cover all the contracts they have, right? They write, so that's their liability. On the other hand, they also will have some financial investment. So both sides altogether, they have to make the decision what's the good liability level, or how much loss they can really handle. So altogether, that's the insurance company itself have to decide internally.
Thank you.
Thank you.
Do we have any other questions for Dr. Yang? Okay, great. So if there's no other question, let's thank our speaker again. Thank you very much.
Thank you. Thank you very much.
Thank you.
Thank you.